Zacks Screen of the Week, an overview of a timely stock screening strategy aimed at helping you produce more profitable investing results. This week's screen talks about growth and value. Goes together like soup and sandwich. Kevin Matris, head of our Research Wizard Division, top stock screener here at Zacks.com, here to tell us all about his angle this week on growth and value. Sounds like a winning formula. I guess you're going to focus in on the right way to find these stocks, right?
That is right. You know, looking for both growth and value, I really do believe that it's a winning combination, especially now with growth rates being so subdued and valuations increasingly getting higher and higher.
Those kinds of companies are still out there? I mean they're out there, right?
Yeah.
I want to scare anybody.
They are out there, but it's becoming increasingly more difficult to find companies that fit squarely in both categories simultaneously. So first off, let me just review what a growth investor looks for.
All right.
A growth investor is focusing on companies with, of course, big earnings growth. And this makes sense because earnings growth is really what drives prices. But even a growth investor doesn't want to overpay for that growth. Now, a value investor focuses in on low valuations, like low PEs, for example. But a lot of these companies with low PEs have low PEs because they don't really have any real growth rates to speak of.
Okay.
They lack earnings power, and that is one of the reasons why, you know, those companies sometimes remain ignored for so long, because nobody is really willing to pay up for those companies because there really isn't anything to pay up for. So by focusing on both growth and value, I think you can eliminate a lot of the pitfalls if you were to just focus on one or the other.
All right, so what is the right way to find both?
Well, I think there is a right way and a wrong way, and what I mean is this. A lot of people will focus on growth and value companies by first searching for one or the other. So for example, if let's say you said, show me the top growth companies, the top, let's say 100 growth companies, for example. Then you said, show me from that list, then show me the companies with the lowest valuations. You may find that those companies with the biggest growth rates all have valuations that are quite high, let's say with PE ratios over 20. So if you're first focusing on growth and then you're paring down that list looking for value, you may not really be finding the best of the value stocks within that category. Likewise, if you said, okay, show me the companies with the lowest PE ratios first, and then from that list try to narrow it down to find companies with the biggest growth rates from that list. Once again, if the companies with the lowest PE ratios have subpar growth rates, you're also not finding the companies with the best growth rates. You're only finding the best of kind of the anemic companies. So again, you've missed your goal of finding both growth and value target plays. You can always try to straddle the middle by saying, show me companies with, let's say, PEs less than 20 and growth rates over 20, but you're going to get a ton of average companies. And once again, you're not finding the best in each one of those categories. So that is why I believe, and that's the focus of this screen, I think I have the right way to find the best of both worlds.
All right, tell us how to do that.
Well, what I'm doing is I'm using a ranking function called a uniform rank, and I'm applying this uniform rank to both categories. This allows me to find the companies that truly are the best in each one of their individualized categories, and that is the basis of this screen, so let's check it out.
All right.
The first item in this screen is I'm looking for companies with a one-year projected growth rate better than 80% of all of the other companies out there. And the way I'm doing it is I'm, again, applying a uniform rank of 1 through 99, 99 being the best growth rates, and I screen for stocks ranked 80 or better, meaning they are better than 80% of all of the other companies out there in terms of their growth rate.
Got it.
The next one is I'm looking for companies that also have the lowest PE ratios. I'm using F1 for this example, but they have to have PE ratios lower than 80% of all of the other companies out there. And again, I'm using the uniform rank, 1 through 99, this time 99 having the lowest PE ratio, in other words, the best PE ratio. And I screen for stocks ranked 80 or better, meaning companies with PEs lower than 80% of all of the other companies out there.
All right.
For good measure, I'm also looking at companies that have a Zacks rank of a 2 or less, meaning no holds, sells, or strong sells. And I'm also looking for companies that have a price of greater than $5 with average daily share volume of at least 100,000 shares or more. So what we're doing with this screen is we are not necessarily looking for one and then narrowing that list down for the other. The order of these items that we just went through is completely irrelevant. If I were to switch the order around, they would still produce the same stocks. Because essentially what we are doing is we are saying that for each one of these categories, they have to be within the 80th percentile of their group. In other words, better than 80% of all of the other stocks on both growth and value simultaneously. By the way, too, the way I'm doing this is I'm doing it with the calculation expression feature within the Research Wizard. So for those people who are doing it at home, this is what the calculation looks like, and it's the first 2 lines of the image that you see. And this screen, by the way, is also included in the Research Wizard. It comes preloaded, and it's called SOW Growth and Value.
All right. Well, you know, my last question is always how many stocks came through the screen?
There was about, I think, 27 stocks that came through the screen this week, and I've got 4 of them for you here today. One is Deutsche Bank. The other is New Market. The next one, I'm not even going to try to pronounce it. I'll just say it's SBS. And then the last one is Seprecor. And again, all of these companies, not just those 4, but all of the companies on the list have market-beating growth rates, below market valuations. Once again, a very potent combination.
Come on, you can't say Compagnia di Sanamento?
Exactly.
You disappointed me.
I thought it.
If you want to check out the text version of this week's Screen of the Week, get on over to Zacks.com's homepage and click on the headline right next to Kevin's picture. You know, Kevin uses the Research Wizard, as he said, to achieve all of these screens. And if you want to know more about that handy little tool, get over to Zacks.com/Research Wizard. You can find out more about it. You can even order a copy for yourself. With Kevin Matris and the Screen of the Week, I'm Terry Ruffalo.